Hello, and my name is Tom Clendon, and I am an SBR online lecturer, and I'm talking about accounting standards. And today, the topic that I'm talking about was chosen by my LinkedIn followers, and the topic is pensions. The topic is IAS19 Employee Benefits. Now, this is a complicated topic. I can't show you numbers in front of you. I can't work numbers, but I want you to understand the basic principles around the accounting for pensions. And in order to do that, I need to perhaps patronize you and to remind you that we're only ever looking at pensions really from the perspective of the employer, who regards pensions basically as an expense. And we can think of pensions from the employer's point of view as effectively deferred remuneration, in that they could have a member of staff who works for them for 40 years, from the age of 20 through to 60. But if that individual is entitled to a pension and is then going to live for another 20 years, the cost of providing that pension to the pensioner, to the ex-employee, really needs to be charged during the employee's working life, because that's the basic matching concept. The employee is giving benefit whilst they work, so the cost of providing a pension should be charged during the employee's working life, matching. Now, for accounting purposes, there are two totally different types of pension scheme. And right from the off, we've got to make this distinction. There's the DC and the DB. The defined contribution scheme, I love it. And the defined benefit scheme, oh my God, it's complicated. So let's pick the low-hanging fruit first, and let's deal with a defined contribution scheme. Now, this is the simple one, because the employer has defined the contribution that it is going to pay into the pot, that it is going to invest on behalf of the employee for the employee's pension. So it simply says, I will pay in a percentage of your current salary. So if we have an employee who is earning, say, $40,000 a year, the employer might say, I will give you a 5% defined contribution pension scheme. Now, what that means is the individual continues to receive their basic salary of $40,000 a year. But on top of that, what the employer does is to say, I will take 5% of the 40,000. I will take $2,000, and every year I will pay that $2,000 into a pot. And over the employee's working life, that pot will grow, and that pot will be then used to buy an annuity or used to finance the pension of the individual. Now, from the employer's point of view, this is very simple because there is no legal or constructive obligation whatsoever to make any payments other than the 5% every year. And if the 5% is paid every year, it's clean, it's simple, there's no ongoing responsibility. And that's why this type of scheme is very popular with employers. If that money is invested badly, if that money is invested well, it doesn't really matter to the employer. They've kind of washed their hands of it, and the risk and reward associated with the ultimate pension is in the hands of, is borne by the employees. And these types of schemes are very, very popular. They're very, very popular because they are simple with the employer's perspective. This is not difficult to account for, and there's no ongoing responsibility. Defined contribution. And it may well be that a number of you listening are in such a scheme. And it may well be that some of you listening also are required to put in some of your own money into the pension scheme. But from an accounting point of view, I don't really care if you put your money in, because I'm only interested from the company's point of view. And you've got a wages cost, and if you put some of your wages into this, it doesn't alter the cost of the company. The cost of the company will be 5% of your salary, or 6%, or whatever it is. It's an extra cost when that payment is made. Credit cash, debit wages. And if you put your wages in cost of sales, or you put your wages in admin, that's where it goes. Of course, there's a disclosure in the notes. There always is going to be a disclosure, but in our exams, we don't focus on that area. It's a simple scheme. Defined contributions are simple. And there, a defined contribution scheme is one scheme, and the defined benefit scheme, the DB, the defined benefit scheme, is the second scheme, much more complicated, and that's what I want to talk about now. With a defined benefit scheme, it sort of does what it says on the tin. The employer has defined, the employer has promised the pension benefit. It's promising, it's guaranteeing that the individual will receive a certain pension of a certain amount. Now, it's very complicated, but fundamentally, the amount of that pension that guarantee will be expressed with two variables. One is the salary, the final salary, the average salary, and the second is the years of service. So which employee is going to get a big pension? The type of employee that gets a big pension is one which has worked there for 20, 30, 40 years. Because every year you work at the company with a defined benefit pension scheme, you are entitled to a bigger pension. You earn your years of pension. And secondly, because your pension is going to be based on your salary, whether it's your average salary or whether it's your final salary, because it's going to be based on your salary, you will get a bigger pension the more you are earning. So clearly, the directors who are there for a long period of time, the best employed, the best paid employees who are long standing, are going to get a large pension. And in theory, if somebody is on $60,000 a year and they've worked there for 40 years, it may well be that in their retirement, they get a pension of something like 2/3, something like $40,000 a year. So that's the background around a defined benefit scheme. The employer is giving a guarantee. Now, it's so complicated to work out the numbers that in an accounting exam, you're given those numbers, because those numbers in reality are worked out by an actuary. And the actuary has to make a whole series of complex, long-term estimates and judgments. What's the wage inflation going to be? How much will somebody be earning when they retire in 20 years' time? When they do retire, how long are they going to live for? If we start putting money aside now, what's the investment return on that going to be on the next 20, 30, 40 years? So these are very long-term, complicated judgments and assessments that are made by the actuary. Now, in an exam, you're given the number, it's 10. You're given the number, it's 20. And then I can debit and credit. But if I'm explaining the principle of these numbers, it's relevant to say they're difficult to understand. It's relevant to say that they are subjective because they're based on these estimates. We're given them effectively by the actuary. Now, I want to think about defined benefit pension schemes from the perspective of the final accounts. The balance sheet, the P&L, OCI, cash flow, the financial statements. What is appearing where? And the natural place to start is the statement of financial position. Defined benefit schemes. We've given a guarantee to finance a pension of a certain amount. And on the balance sheet, that pension scheme is most likely, highly likely, to be in deficit and to be a liability. Because what happens is that every year, the employer, on the instructions of the actuary, will pay a certain amount of money into a pension fund. So the employer will make a cash contribution into a pension fund. So assets are built up to cover the pension liabilities. Now, those assets are required to be measured at fair value, which probably means level 1 because they will be observable stocks and shares in a traded market. But the pension fund not only has the pension fund assets, but will also hold the responsibility for the pension fund obligations, for the responsibility of paying the pensions in the future. So, because the responsibility is to pay the pensions in the future, when we measure those at fair value, they're going to be discounted back in today's monetary terms. And as I said earlier, the normal scenario is that the pension scheme is in deficit. So if you've got pension fund liabilities of 100, it may be that your pension fund assets are only 80. They don't cover the amount of the obligation. Therefore, the company has an obligation to make good the deficit. The company, having given the guarantee, is responsible for the 20. And that liability is a non-current liability of the company, of the employer. So the employer will recognize on its balance sheet as a black hole, as an ongoing, open-ended wound, it will recognize the pension fund deficit as a liability. It is possible it can be an asset, but let's not worry about that today. It is normally a liability. So that's the balance sheet. There's one number, you're given 100, you're given 80, wham, bam, on your balance sheet, non-current liability 20. Very straightforward numerically, but obviously takes a little bit of explaining. Secondly, let's think about the P&L. And there could be up to 4 different expenses charged in the P&L. Something that you will definitely see every time is a current service cost. Now that's jargon. Current service cost. Now that current service cost has to be a charge against profit, and it represents the increase in the pension fund liability because of the staff that have worked there this current year. They've given current service this year, therefore there is a cost to that. Because they've clocked up another year's service, they're entitled to a bigger pension, so there's a bigger liability, so we need to charge that this year. Debit the P&L, credit the deficit, credit the pension fund liability. A current service cost is the cost of current service. A current service cost is the increase in the pension fund liability because of staff have worked that year. It's always going to be there. Second expense that you come across in the P&L that's a regular item is a finance cost. As soon as we've started talking about fair values and present values in measuring the deficit, yeah, we've got a deficit in our case because the pension fund liabilities are 100 and their assets are 80, so there's a deficit of 20. That's been measured at present value. That needs to be unwound. So it's the discount rate at the beginning of the period that will be used to create a finance cost for the year. The liability gets bigger because it's a year nearer being paid at the end of the year than it was at the beginning of the year. So there's a cost. There's a debit to the P&L, there's a cost, there's a finance cost, there's a credit to the liability, there's a credit to the deficit. Expense number 2. Now, expense number 3 and expense number 4 appear in exam questions more often than they appear in real life because I think they're both relatively unusual. The third one is the past service cost. Now, this is an increase in the pension fund liability, an increase in the pension benefits, because somehow the employer has been very generous and enhanced the pension rights of the employees, not because they've done anything this year, but just because they have enhanced them. So, I don't know, let me give you a silly example. If the employer suddenly turns around and says, in addition to the pension, I'm going to pay you $100 on your birthday every year when you're retired for the rest of your life. Now, that is an enhancement. That is a past service cost. That is an increase in the pension benefits, because if that individual is estimated to live for another 20 years in retirement, that's another $2,000 that will be paid out, albeit that it will be paid out in the future, so it will be discounted back in today's monetary terms. So the increase in the liability won't be the full 2,000, it will be a present value, but don't worry, you'll never have to calculate it. The increase in the liability of the past service cost is going to be charged absolutely straight away to profit, not spread. In no way, it's just charged straight away. Past service costs. Fourth one and final one I'm going to share with you is settlements and curtailments. And this is to do with redundancies. This is to do with retrenchment. This is to do with early retirement. Now, my late father-in-law, David, he worked for ICI. And he'd worked for ICI for 32, 33 years, and he was in his mid-50s. And he was looking forward to retiring in 5 years' time. He was looking forward to retiring on a full pension. Then he was made redundant. Now, to save his dignity, they didn't say, you're being made redundant. What they said was, we're going to offer you early retirement. Now, I can remember when he was offered early retirement, he was initially confused because he said, look, I'm 58. How am I going to live for another, what am I going to live off for the next 5 years until I was due to retire? And ICI, being a benevolent employer, said, look, don't worry. By making you an offer of early retirement, we will allow you to draw your pension straight away. Now, the actuary hadn't taken that into account previously, so suddenly the liability, he said yes, so suddenly the liability jumps straight away because there's another 5 years of pension liability that has to be accounted for. So on early retirement, on retrenchment, on redundancy, where the employer is generous in the terms over and above the legal minimum that the actuary has taken into account, that increase in the liability creates an expense which is recognized straight away. So there are 4 expenses: current service cost, past service cost, finance cost, settlement and curtailments. and they all fundamentally have the same debit and credit. They're all expenses, debit the P&L, and they're all credits in that they increase the liability, they increase the pension fund deficit. Now, this leads me on to my third statement, the cash flow statement. Because these four expenses have been charged against profit, but they're not cash outflows, in a cash flow, when you're doing the operating activities, when you're doing the indirect method, you are adding back depreciation because it's a non-cash expense. You're reconciling the profit to the cash generated, and depreciation has reduced the profit but not reduced the cash, therefore you add it back. So you add back current service costs, past service costs, settlement and curtailments, and the finance cost on the unwinding of the discount. So in the cash flow, reconciliation, indirect method, they're added back. Now, I talked earlier about there being a contribution that under the advice of the actuary, the employer would make a cash contribution to the pension fund every year. And that is a cash outflow of the company. And that cash outflow of the company is an operating activity. And that would therefore appear at the bottom of the operating activities section, sort of alongside interest paid and taxation paid. So there is a cash flow element to defined benefit pension schemes. Now, the fourth issue that I want to talk about, we've talked about the statement of financial position, we've talked about the P&L, we've talked about the balance sheet, we've talked about the cash flow. The fourth thing I want to talk about is OCI. Other comprehensive income, that thing that is tacked at the bottom of a P&L that deals with all the rubbish, that deals with all the unrealized gains, the revaluations, the kind of weird stuff. And what we've got with a defined benefit pension scheme is a remeasurement gain or loss. Because every year what happens is the pension fund assets and liabilities will be remeasured at the year end to their fair value. So we have a fresh number, a new number that goes on the statement of financial position as the non-current liability, as the deficit. Now, when you reconcile that from the opening to the closing by adding on all the expenses that you've charged against profit, taking away any cash contribution, there's going to be a difference. And that balancing figure is the remeasurement gain or loss. It's come about because in the light of experience, the gains or loss, in the light of experience, the pension fund assets and liabilities, the deficit is a different number from what you would have expected. And it's come about, you remeasure those assets and liabilities, therefore you get a remeasurement gain or loss, which is clearly a weird, unusual, non-recurring, non-operating figure that is dumped in OCI, other comprehensive income, taken directly to equity. You don't want it anywhere near P&L. You don't want it in earnings per share. You don't want it polluting your core regular earnings because it's just a kind of one-off weird thing. And the standard requires that it is not to be recycled. Now, what I wish I could do, but it's a podcast, what I wish I could do is now kind of, show you some numbers, take you through an example, talk to you about some other stuff. But my intention was to try and explain and give you an understanding of how the accounting for pensions work. And I hope that you have understood it. If this is the first time that you've thought about pensions, oh my God, you've got a headache, so much has sort of escaped you. But if you have looked at pensions before, then I hope this has been a useful recap and given you a bit more depth and understanding of how we account for pensions. And it started with the fact there are two different types: defined contribution where there is no obligation, no guarantee, that there is a fixed amount that you pay and that's it, and a defined benefit, which is much more complicated, which is the open-ended nature of it. So fantastic. This has been the longest podcast that I have done to date. I'm almost coming up to 30 minutes. So well done for listening so far. If I can help you pass SBR, get in touch. I do mock exams, I do tuition, I do revision, I give guarantees to people to help them pass their exams. I work them hard. I'm interested in success and helping people pass their exams. So reach out to me. I'm easy to find. Find me on LinkedIn. Find me through my website, www.tomclendon.co.uk. And I hope you've enjoyed this podcast and enjoy the other podcasts in this series as well. Thank you very much for listening. God bless.